Stocks, bonds, cash. How should you be rebalancing your portfolio after the US Federal Reserve surprised investors with a jumbo rate cut? Lower rates mean that it's cheaper to borrow money, and one of the first to benefit will be small mid-cap companies.
When interest rate comes down, it is much better for their borrowing costs, and that will subsequently help bottom lines. I think that's one part. Second part, typically during an interest rate cut cycle, barring it doesn't result in a recession or a crisis, you do see valuations increase as well in the small mid-cap stocks. And the third is investors have been very much crowded in a small handful of mega-cap growth stocks, especially those in the US. So this concentration will have to broaden at some point, and we feel that small mid-caps may also be a beneficiary of this.
Within the Asian equity space, analysts say high dividend stocks are set to outperform in the long run. That's because in a low-rate environment, investors face a declining yield from their savings and bond instruments, and so are likely to seek higher income opportunities.
Many of these Asian dividend stocks right now are giving yields between 4 to 5%. So that's quite an attractive proposition. As interest rates come down, the differential between this dividend and interest rates will widen, makes them more attractive. So for example, in North Asia, like in markets like Korea, we're seeing the regulators have a new value-up program. They're encouraging corporates to start distributing more. We find that's a catalyst. Or in China, the regulators are also encouraging companies to pay more dividends, to be more shareholder-friendly.
Closer to home, there are opportunities in the Singapore stock market.
So one, the market has a significant concentration in interest rate sensitive sectors like REITs, right? So they tend to do well in the rate cut cycle. You're getting a nice level of yields on average in Singapore stocks of 4.5% to 5%. That's also quite attractive. And valuations are pretty attractive as we speak. We find banks may still do well, but maybe not outperform as they did before, because lower interest rates tend to be a little bit less of a tailwind or a catalyst for their earnings over time. Telcos, they tend to be very much like bond proxies of sorts, right? Because they have a very stable business, predictable cash flows that come through, so they behave quite like bonds. So when interest rates come down, telcos tend to also do quite well themselves.
Low interest rates in the US could also see a softer US currency. This could be good news for Asian stocks.
A strengthening dollar tends to put a bit of headwind on Asian equities. So when the rate cut cycle happens, the dollar tends to ease a little to varying degrees. That reduces that pressure or the headwind on Asian equities.
Bonds is another asset class investors should consider in a low interest rate environment. Bonds not only deliver consistent interest income, but also benefit from capital appreciation, a key advantage when rates are on the decline. Long-term bonds benefit the most because they lock in higher yields over time.
I think bonds are still a relevant investment. They've had a pretty good run, but with 10-year bond yields currently sitting at around 3.65, we're not priced for a recession, we're just priced for a Fed that's easing policy. So if the Fed delivers on those cuts, I don't see much upside, nor do I see a lot of downside for bonds. But if the economic conditions continue to deteriorate and we do transition from a growth scare into a recession, then I think bonds can perform quite well.
For investors looking at buying bonds in Singapore, think long-term. Bonds with shorter-term duration, like T-bills, carry reinvestment risk. That means that you may not enjoy the same level of income on new purchases of such bonds as interest rates head lower.
So T-bills tend to be very sensitive to short-term interest rate movements, right? So investors in them, when the interest rate cut cycle happens, they face reinvestment risk. They may potentially have to reinvest at increasingly lower yields, right? So for investors with a slightly longer horizon, we recommend maybe they consider other instruments. So for investors that are more income focused, SSB allows and has a predictable step up in yields. However, they don't have that typical price appreciation you might see in an interest rate cut cycle.
I think those things are a good place to hide. But again, I'm concerned about the economic outlook. I think that we could transition from a growth scare to a recession, and in that environment, return of capital is going to be more important to investors than return on capital over the next 12-18 months.
The Fed rate cut could be a boon for some commodities like gold. Lower interest rates typically make gold more attractive as an investment because it does not earn interest. Investors also tend to turn to the safety of non-yielding bullion in times of uncertainty and when there are fears of a recession. Since the start of the year, gold has been hitting new record highs, driven largely by emerging market demand.
I think gold is buyable on any pullback, and if we continue to see a global easing cycle, that's probably a pretty benign environment for gold. Silver is more volatile, it has more industrial use than gold, but I think silver can also perform quite well. And I think in an environment of a global easing cycle, commodities more broadly should perform pretty well.
As interest rates trend downwards, investors will also need to rethink how they want to optimize their cash.
Don't hold too much cash and start to think about putting your cash to work. Because as interest rates come down, cash rates, even T-bills, the yields, the rates on those will start to come down. So investors within their risk tolerance, if they can take a little bit more risk, can consider deploying some of this cash into other fixed income instruments.
I think cash gives you optionality, it gives you options. If we do get a recession, high quality stocks are likely to go on sale, and having some cash allows you to take advantage of the sale.
Experts say you should also try not to time the market.
So in a rate cut cycle, you tend to also see volatility in market, right? Which kind of makes investors sometimes want to time market, but really over time it's shown that timing the market tends to be a pretty fruitless exercise. Time in the market is much more important to timing the market from our perspective.
Whichever asset class you choose to put your money in, brace yourself for some short-term volatility with the US elections just around the corner.
Through election cycles, you may see volatility entering into an election cycle, but after which markets tend to move on and fundamentals, valuations, earnings will drive markets.